Welcome everybody. And today we're going to talk about the proposed tax legislation, which currently sits in the Senate being deliberated. There's activity this week, and we'll actually talk about a couple things that happened yesterday, probably as we go along in the Senate. So the House did pass this bill, so there's a lot for individuals, businesses, and nonprofits. So we've got our panel today is Jim Brandenburg, who's in our Milwaukee office. Everybody knows Jim. I sit in our Indianapolis office. Emma Smith is in charge of our state and local tax practice, and she's in our Naperville office. And Jill Boyle is over our nonprofit tax practice. And there are some provisions that affect both SALT and nonprofit in this bill that we thought would be good to have them on. So welcome to all of you today.
Thank you.
You got a little disclaimer. We'll let you read that on your own at your leisure. Couple things here as we move forward. Welcome questions. Submit them via the question feature in the chat in the control panel. We do have a PDF of the slides available in the handout section, along with some other handouts. Some of which, frankly, remember this is a proposal. Some of which have changed and could change some more as we move through the legislative process. So keep that in mind for the handouts and frankly for the slides as well as this proposed legislation moves through the House or through the Senate and then maybe back to the House again. If you'd like to receive CPE credit, we have some polling questions that you'll need to answer. Brief survey at the end. We'd ask for you to complete that, and then CPE certificates for those of you who need CPE. We'll circulate those via email in the next 2 to 3 weeks. So with that, today's topics, there's a recurring theme here called the One Big Beautiful Bill, and if you see it OBBA, the A is the act. So the One Big Beautiful Bill Act. We're going to talk about what's in it, but backing up, the TCJA sunset is really what's driving this legislation. So we'll cover briefly some of those provisions that are important to us individually and as businesses. We'll talk about what's in the bill. We'll talk about the state tax and exempt org, some of the key provisions that are in the proposal. And then what happens next, and somewhat timing as to when we think the bill might be passed. So we've got our first poll question. Jim, would you recognize that some of these topics may be new to you, but we're just trying to get a sense of our attendees today. So Jim, would you read the poll question?
Yeah. Okay. What individual tax provisions in the One Big Beautiful Bill are you most looking forward to if the bill is enacted into law? So sort of as it stands now, as you've maybe heard some of these items, we'll be talking about a few here. Our four choices are the higher child tax credit of $2,500, the continuation of the current income tax rates, the enhancement of the 20% business income deduction up to 23%, and the higher SALT deduction cap of up to $40,000. So let's see what we've got on that. We've got about 3/4 of the folks have voted here. We'll close off the poll here in a moment. Okay, we ended the poll here. Thank you all for voting with that. It looks like the continuation of the current income tax rates, 39%. And we've got the SALT deduction cap, again, 40,000 is 27%, 21 on the child credit of 2,500, and then the QBI deduction up to 23% at 13%. So thank you for doing that.
Okay. Wanted to check here. My slides advancing correctly. Can you see those? We just want to make sure no, they're not.
No, we're still.
We may need to have someone else advance the slides. So give us just a second. Maybe we'll send that back to our fine support folks, and maybe they can advance the slides.
You're back, Tom.
Yeah, but we're back. Do we have can someone else advance the slides for us, or can we have someone else share the slides? I have some sort of technical problem here. There we go. We'll need to go to, yeah, there we go. Thank you. Sorry about that, folks. Sometimes the slides don't necessarily work correctly. So we'll keep going here. Thank you for your patience with us. Jim, why don't we go ahead and jump into the TCJA sunset?
Okay. Yes. Thanks, Tom, and good morning, everyone. Thank you for joining us, and thank you for our staff, Stephanie and Mimi, for their help in coordinating everything and working behind the scenes. We appreciate all their work with us too. Again, this big beautiful bill again really has its origins back to the TCJA back in 2017 when in President Trump's first term. Again, this was comprehensive tax legislation. Many of you recall, $1.5 trillion of cuts for business and individuals. Had some simplifications, a lot of complicated items in there. Unfortunately, due to the budget reconciliation, which we'll talk on a little bit, this was not permanent. So a number of those items, especially a lot of the individual items, sunset or expire at the end of this year, and they go to what the law was before the TCJA. So again, significant changes coming possibly if we don't get a bill this year. Next slide, please. Here's some of the items again. We're not going to go into these in depth, but these are some of the ones that will sunset at the end of the year. The individual tax rates, again, that the top rate of 37%, 5 of the 7 brackets were lowered under that. Again, those would all increase. This new, this qualified business income deduction, QBI, which drops the top rate down to effectively under 30%. That came about, that would expire. The standard deduction, which was doubled, the child credit doubled from 1,000 to 2,000. The SALT deduction cap was actually came in. That's one of the items that was not as favorable with taxpayers. That came in $10,000 cap, and the estate and gift exemption was doubled, and then indexed for inflation. So those are items that are set to expire at the end of the year from the TCJA. Next slide, please. But there also were some items that were, quote, permanent. And again, were not scheduled to sunset. The corporate tax rates, again, dropped down to 21%. And then some business provisions, we'll talk on these later too. Bonus depreciation, again, went up to 100%, but then started scaling back in 2023. R&D expenses had been currently deductible, and starting in 2022, you had to amortize those. And the interest expense deduction had a new change that went in there, and they made some revisions to how you calculate that starting in 2023. So these were all items that were permanent items that were part of the TCJA. And again, these are already in the law now at this point. Next. Again, just recall that if we don't get a bill, and again, the bill is getting close to the finish line, but if nothing happens here, something will happen next year, okay? The tax rates will increase pretty much across the board, and estate tax and everything else will go up. So to keep the status quo, keep the current rates in effect, we need to have a bill passed. So that's why they've been working on this bill here. The TCJA, though, that we've gone through, that'll be the cornerstone of this bill. And the 4 main areas that are going to be in this one big, beautiful bill that Tom mentioned at the outset, the extension of these TCJA tax cuts, some of the campaign themes from last year. There's some other initiatives, and then there's a few pay-fors, or those are items, some offsets that are included in the bill. And again, it's a comprehensive bill. We're going to cover selected items that are going to be in this one big, beautiful bill. So next, please. So first, we're going to look at in this one big, beautiful bill, again, some of the items related to the TCJA extensions that we're going to go through. Again, as Tom mentioned, we're going to look at the TCJA, some of the campaign themes, the SALT changes, some of the items that will impact workers and businesses, and then some of the items that Jill's going to cover related to tax-exempt organizations. Next, please. First thing, and again, selected items here, the individual rates. Again, as passed by the House here, these individual rates will be extended beyond starting in 2026. So the rates will range from 10 to 37%. Again, this will be a permanent change. It's not going to sunset after a number of years. And we tried to highlight in some cases in the slides where there is something that's permanent. And permanent in the sense Congress could always and the president could always change a law, but they've got to go through the process to do that. But there would be no scheduled sunset or expiration of that provision. So that's what we mean by permanent with it. The other thing, the standard deduction would be doubled, would be increased. Plus, there's an extra amount that applies for the next 4 years. So in 2026, that the standard deduction actually would be for a married couple up to $32,600. The child credit would be extended, made permanent, and actually for the years 25 to 28 will go up to $2,500. And this qualified business income deduction again would go from 20% up to 23%, again, which drops the top rate for these businesses down about to 28.5% for those that are taking advantage of this QBI deduction. There's also some other tweaks that they made with the QBI calculation, which are favorable with it, that are part of this bill as well. Next slide. Another one of the TCJA changes is AMT. It had used to be a big issue for a lot of us. Again, they brought some relief. That relief would be permanent, which is will help out a lot of taxpayers and practitioners. The estate exemption will be set at $15 million next year, indexed for inflation, and that will be permanent. Residential mortgage interest, again, used to be at $1 million, was cut down to $750. That will continue starting in 2026, and that's not indexed for inflation. And then the last one, there's an itemized deduction limitation. We used to have this back before TCJA. It was called the PEAS adjustment that kind of took away some of your itemized deduction benefit. That's not returning, but there's a different one that will make some adjustments that those in the top tax bracket will lose some of their deductions. And again, that would start next year with it. So something to be aware of.
So Jim, a couple things that we're not going to talk about today that in the interest of time, the QOZ, Qualified Opportunity Zones, is not something we've got in this presentation today. That provision from was new in 2017. There's enhancements to that, changes to that, but that provision is proposed to continue. And international provisions generally will be extended. In the interest of time, there's a lot in this the keyword big, beautiful bill, so some of which we can't cover. We'll go to the next slide and maybe turn it over to Emma, who is going to talk about some of the state and local considerations. And Jim talked about the itemized deduction limitation. Emma, there is a somewhat of a, what's an itemized deduction affects the new proposal on state and local tax. So please take it away.
Yeah, so I'll start with the SALT deduction cap been a big point for business owners and also people in high tax states, your California, New York, Illinois, New Jersey, those states where they have a really high income tax. So this limitation has impacted a lot of taxpayers. So the conversation, and it was added at the last minute when it was in the House, was increasing that cap to $40,000. With that cap being increased, there would be a phase down to the $10,000 if the taxpayer's AGI is over $500,000. And if it's a single taxpayer, you're going to divide all those in half. So it'll be a $20,000 with a cap or a phase down to $5,000. So just keep that in mind. And that would be effective for 1/1/2025. So that would be one that's kind of that retroactive to the current year. But again, this $40,000 cap is something that is one of the biggest debated right now in the Senate because it doesn't have the support in the Senate that it did in the House. But it is going to be one of the items that is discussed further. And again, the biggest thing is those high tax states are the ones that are fighting for this because that $40,000, when you think about your W-2, your property taxes, that's all what's limited by this $10,000 cap. So small business owners are largely impacted by it, but also anyone that has a large W-2 or pays a lot of property tax. That $10,000 is a very small amount, so the $40,000 would be a huge increase for those individuals. I'll go to the next slide. with the cap being increased to $40,000, that was just part of it. The other part of the bill is really looking at what is known as the pass-through entity tax and that regime that came out of the 2017 bill. So the pass-through entity tax is where a small business, so a partnership or an S corp can make an election to be taxed at the entity level in certain states. There are currently 36 states right now that have a PTET election, and there are 2 states that have it proposed, and there's 4 states that have nothing in legislation right now to have a PTET tax. So what that allows is the business to take a deduction for that state tax at the entity level, which then reduces taxable income. So it's a workaround for that SALT cap. So you're reducing your federal income, and then you're not having to worry about that cap at the itemized. Now, what they're talking about with the new OBB bill is that they're going to put a lot of requirements now on these PTET kind of workarounds. So there is discussion of additional K1 reporting to make sure that it's being properly reported on the K1 and impacting basis. The other area is they're talking about only qualified businesses can take this deduction. So that would remove the deduction for a lot of service-based companies, specified service. So your accountants, doctors, lawyers, dentists, things like that would not be able to take this deduction. So it's going to kind of follow the QBI rules, but there's also an additional level of there's going to be a 75% test. So it's going to look at related companies. So if you have an operating company that has a qualified trader business, but then there's also a real estate company, this new bill could technically look at the gross receipts as a total. And if you don't meet that the 75% of those gross receipts qualify, then you would not be able to take that state deduction. So again, this is going to be huge impact. This is one of the things that they're discussing. So we're going to see a lot of change probably in this after it comes out of the Senate and then back to the House again. So just be aware, a lot of moving pieces with the state, but if you have a small bit or a business, this could largely impact you. So just keep an eye on this. And if you have any questions specifically to this, feel free to reach out to my team. This is something we're keeping an eye on, or just in general, your state and local taxes, we're available to help you guys.
Thank you, Emma,
Hey,
very much.
thank you, Emma.
Appreciate that.
Yeah. Let's go to the next slide, and we'll continue on with some of the newer campaign tax themes we might remember hearing about earlier before the president was elected. Jim?
Yes, thank you again. Thank you, Emma, with it. And these are, again, beside the TCJA items, we're going to be some campaign themes. The first, as many of you have heard, is this no tax on tips. Again, a popular idea to have exclude that tip income. It received a lot of bipartisan support, last year and even this year with it. And what they've came up with in the bill here is this tax deduction for qualified tips. And again, the individual, or it could be somebody who has either a W-2 or a 1099 that gets tip income, could get a deduction for the tip income that they get. Now, what they're looking at is professions or workers that traditionally do get the tips, and they're going to look at businesses that got tips at the end of last year, so people can't start creating tips this year with it, businesses with it. And what they're going to do is list some guidance on, what industries or occupations are going to be eligible for this, and they're going to require that the IRS, within 90 days of this bill being finalized, would have to provide a list of occupations that are eligible for this tip income. Next. The other thing with it does not include certain things here. Again, the tip needs to be voluntary with it. So if it's assessed on there as a service charge, it's not going to work. It needs to be voluntary. These SSTB that Emma just mentioned here, those type of businesses, professional services, those would not be fall within this. And if you're a highly compensated employee, you're above a threshold amount of $160,000, you wouldn't be able to take the tip deduction. And there may be some other requirements that the IRS provides in guidance once this is out there. In addition, for an individual, if they take the standard deduction, they're going to be able to get this tip deduction in addition to that. So just keep that in mind. Next. Social Security is going to be required with it. So again, they're going to have the income, the tip income included in your income in the W-2, and then you're going to take out a deduction on your tax return for the tip amount. So that's the way that they're going to report that. So you need to have a Social Security number to to be able to take this tip deduction with it. There will be some IRS guidance again that will provide some of the details and try to prevent any abuse with it. Again, this tip deduction though is not permanent. Again, it's only going to apply for the years 25 to 28. Since it has some of this bipartisan support, you would think it would continue after that, but that's something we'll have to watch down the road. Next one, no tax on overtime. Again, another campaign theme, and what they refer to it as qualified overtime compensation. Again, one thing just to note with it, it mentions specifically it doesn't include tips, so you're not going to get a double benefit for it here. And also highly compensated employees, and they're going to have the rules for that, are not able to take this, and they have a limit here for 2025, $160,000. And apparently there's no phase out with it. So if it's 160,000 or less, you'd be able to get this deduction for overtime. Next. Again, this overtime, again, it's going to look at the Fair Labor Standards Act. Is going to define, what qualifies for overtime, your amount that exceeds your regular pay. So the one thing to note with this is it's the premium you're getting for working overtime. That's what you're going to be able to get this deduction for. So if a worker gets time and a half for working overtime, it's that half, that extra that they get. That's what's going to be eligible for the deduction, not the full amount that they work, but just that time and a half, or if it's double time, the extra amount. The same thing is with the no tax on tips. If you take the standard deduction, you're also going to be able to take this deduction for no tax on overtime. That will be allowed in addition to the standard deduction. So something to be aware of. Again, as with the tips, again, Social Security number will be required with it. They'll be recording. It needs to be on your W-2 with it. They indicate that the IRS will need to adjust its withholding tables for it. So if they know that you're going to have some of this overtime income that's going to be non-taxable, that they would adjust your withholding tables for that. And again, they're going to have to issue some rules out there, and again, to make sure that it follows what they intended to do and not provide any abusive situations. This one too, again, is effective for 25 to 28. So it's going to be interesting that employers are going to have to go back to the beginning of the year to make some adjustments for to make sure they capture those amounts for the overtime that's been earned for the first part of the year here.
Or in theory, if you had overtime included, you may have sort of over withheld on your taxes.
Potentially, yeah. So the
refund.
withholding will be different. It will be kind of hard for this year, but at least hopefully they'll get it in line for next year. But right, you will be able to take that deduction on your tax return for 2025 then. Next is a new one. It's a senior deduction. Again, one of the campaign themes was no tax on Social Security. And according to the budget reconciliation rules, they really can't, address Social Security with it. So what they came up with to provide some relief is the senior deduction for those that are 65 and above. There's a $4,000 per individual additional deduction that they're entitled to. There's a phase out if you're modified AGI, again for married filing jointly is 150,000 or above. 75,000 for other taxpayers, and it gets phased out. That deduction is allowed whether you take the standard deduction or you itemize your deduction. Okay, so that's just the additional amount. Again, that applies for the years 25 to 28. The next one is a new one that was also in the campaign here is this a tax deduction for car loan interest. Again, you've had mortgage interest. Now they're going to have a new one for car loans. And it's a qualified passenger vehicle loan interest, so they refer to it as. Again, it starts here in 2025. Listed some of the requirements here where it does not apply for lease financing, finance fleet sales, some of these other items. But again, it needs to be a car that's purchased and secured with a lien on the vehicle here. Next slide. With that, a couple things. Again, it's up to $10,000 of interest deduction that you get. But as some of these other items, that's a phase out. Once your income is over $200,000 for married filing jointly or $100,000 for other filers, it starts getting phased out. Phases down at $250 or fully phased out for a married couple and $150 for the other one. And we list the type of vehicles it applies to. So it's pretty much any vehicle that you could have. It even includes an ATV vehicle that is used on land here. So the key thing with this provision, though, is a vehicle that is only the final assembly of the vehicle occurs in the U.S. Again, the theme is to get the production for the vehicles in the U.S. And again, they're going to have to provide some guidance and rules on to where that applies. Next.
And Jim, that's for anything after, that's for 2025 as well.
Correct.
Yeah, interesting.
And then what they're going to have is similar to what you get now on your mortgage interest. I think it's going to probably be like that, where you get a Form 1098 that shows the mortgage interest. They're going to get a form that shows how much interest did you pay on the vehicle to make sure you're qualified. They have a new code section. It's like these code sections are getting too much. You have a double letter here. You have 6050 double A. I guess we're having a lot of reporting here, so they've got to have double letters, but it's going to have name and information, the amount of the loan, and how much is eligible for it. So again, that'll be something that will have to be reported. Again, if the interest is more than $600, if it's less than that, they won't necessarily have a requirement. Again, this deduction applies for the years 25 to 28. Again, to encourage folks that are getting a vehicle, get one that's U.S. made to get this deduction. Again, this is a deduction that you don't have to itemize to get this deduction.
Okay, I think we got another poll question here, and Jim, you want to go ahead and read that, covering some of the recent topics.
Okay, our next poll question. Which of the new provisions would you be most in favor of? These, again, some of the new campaign theme: no tax on tips, no tax on overtime, the senior deduction, and the tax deduction for car loan interest. So we'll get that poll opened up here. Okay, got most of the folks voted, about 80% here.
Looks like the senior deduction is the big winner.
We'll have to keep an eye on that one at some point here.
Yeah, right. I mean, there might be some folks on here who close to qualify for that.
Closed it off here. Looks like we've got 41% for the senior deduction, 29% for the car loan interest, and the last two, no tax on overtime and no tax on tips, about the same, 14, 16% with those. So thank you for responding on that poll there.
Yeah, thank you. So we're going to transition here and talk about a few of our, go to the next slide, a few of our tax exempt provisions that are in the proposal, and we'll turn it over to Jill Boyle. Jill?
Thanks, Tom and Jim. Good morning, everybody. I am here to cover just a few items related to sort of the charitable space, tax exempt orgs that are in this proposed legislation. So generally not great news for our not-for-profit organizations, but we do have a few here that may impact in a positive way that are a little bit more for kind of charitable tax deduction space. So one of them, a federal SGO proposal, which is a new scholarship granting organization classification. There are some states that have similar programs to this in place already, but this is going to be on the federal side. And it's really kind of crazy the way they've written this. It is a 100% federal tax credit for donations of cash or securities that would go to these scholarship granting organizations. That's different from how a typical charitable deduction would be based on a certain percentage of your adjusted gross income on the individual side. So this is a pretty substantial change in how that would be calculated. And that would be for scholarships to K through 12 education, and available 2026 to 29 with a national cap of $5 billion that would end the program. Next slide. So a couple more pieces of this. The credit for the taxpayers is limited to the greater of, which again is unusual, 10% of the taxpayer's adjusted gross income, or $5,000. So it could be pretty lucrative for people who'd like to give for K-12 scholarships. On the student side, the eligible student's household income can't exceed 300% of the area median income, and they have to be eligible to enroll in a public elementary or secondary school. Next slide. So the organizations that are going to be sort of running these donations through to these scholarships are a 501c3 organization, and substantially all of their activities have to be providing scholarships for elementary and secondary education. So kind of some new rules are going to be put in place here for these types of organizations, but also they did mention some of these already exist in those states that have this credit already. And so they are kind of saying that those will already qualify for this as well. So there may be some existing organizations that qualify here, or maybe kind of a new application, a new classification that organizations are going to form under. Next slide. So again, just mentioning many states already have this, and that state credit will reduce the federal credit, or the opposite. So we aren't getting, you can't double dip on both of those. And the onus is going to be on those scholarship granting organizations to confirm that the students meet the eligibility requirements, right? So there's going to be a decent amount of due diligence that happens at those organizations level. And then an interesting also, they're going to require an annual audit of those organizations. So this might impact sort of giving structures for nonprofits that fund scholarships, and also those private schools that exist out there. So could be a real change in dynamic in that space if this ultimately goes through. So again, takes effect in 26 and sunsets in 29. Another topic here, 529 accounts. So I think a welcome expansion to uses of that. So currently you can use the withdrawals from that. They're tax-free secondary education expenses and K-12 tuition. That elementary secondary is capped at $10,000. So the expansion there will be for qualifying expenses for homeschooling, tutoring, test fees, online education materials, and educational therapies for disabled students. And the other thing would be expenses that would be post-secondary credentialing programs. So really just an expansion here that I think is welcome. Good news here.
And now the bad news, Jill.
Yeah, and then now we get into the negative. So we started with some good stuff. Okay. So as we get a little bit more into our specific exempt orgs, the first one here, higher ed impact. Current rules, 1.49% excise tax on the net investment income of an applicable educational institution, which definition is there. And that tax currently really only, research would show it's about 50 to 60 universities that are paying that tax, right? So the expansion of this for 2026 and after, they've sort of changed some of the definitions of how this calculation is done. Now it moves to endowment assets per student, which is a little bit different than it was prior to 2026. So it's intended to expand this tax a bit for those higher ed institutions that have larger endowments. So again, some of them will still be that 1.4% tax. Then you can see it escalates fairly quickly up to those very large Harvard types who presumably are in that last category. So higher ed really need to focus on, if this is passed, making sure you're doing that calculation. I think a lot of, small and medium private schools aren't going to necessarily meet this, but certainly could depending on endowment size. So something to keep your eye on. Next slide, please. So the next is a increase in tax on private foundations. So again, starting with the current rule, private foundations pay a flat 1.39% excise tax on their net investment income, right? So capital gains, interest, dividends. And they're looking to increase this for larger private foundations, right? So if you are under 50 million in assets, that flat 1.39 will stay in place. Over 50 million, you can see there is a escalation here of the tax rate all the way up to in excess of 5 billion at 10%. So the change here, for those larger foundations is the impact this might have on the rest of the tax exempt world, those those public charities who are receiving grants and donations from private foundations. Could see that decreasing over time as these foundations are now required to pay more in tax. That's going to reduce the amount that's getting paid out to, operating public charities. So this could have a negative impact on, those funds that are getting out to operating charities from private foundations. The other impact this potentially has is to make donor advised funds look a lot more attractive to individuals who are interested in philanthropy, because they won't have this graduated tax in place. Next slide, please. So the other thing in here, I'll just touch on, there's a lot more to it, but in the basics of it, the current rule says tax exempt organizations that pay compensation to employees over $1 million, the top 5 highest paid during the year, there is a 21% excise tax on that compensation above the $1 million. The change here is that's going to expand to all, not just the top 5 paid over $1 million. So those large tax exempt organizations, again, this could be a really big impact on some of them. So that's a 21% tax on that above $1 million of compensation. Next slide, please. So I've saved the very worst for last. I thought I'd never need to talk about parking again, but here we are. This parking tax was so terrible that 5-6 years ago when it first came into play, it was repealed retroactively. So someone finally realized how terrible this was. They repealed it. Our tax exempt orgs were able to apply for refunds. It was all paid back. We thought it was gone. I never would have to think about parking lots again. Here we are, 2026, it's back. The one change is that it is not, churches are not subject to it this time around, but really everyone else is. So I'm very, very hopeful this doesn't end up in the final legislation, but it is a tax on an expense, which is really an odd concept in the tax world, but so on that note, I'm very hopeful this goes away and I don't really actually need to talk about it again, but it's out there, so I wanted to point it out. Jim, do you have some better news for us?
Yes, thank you, Jill. Thank you so much. We're going to go back to some more of the business provisions in the One Big Beautiful Bill here. Just wanted to cover these, and we're going to have Emma comment on a couple of these items too, as far as when we get through some of these business items that may have a state impact too. The first is one of the big items for businesses that I've been following going back. I mentioned at the outset was the bonus depreciation, which was is 100. Now it's actually 40% for this year. We'll go back to 100%. That's one of the changes within here. Again, the TCJA had to phase down starting in 2023. What would happen with in the bill here? This would go back to 100% bonus depreciation, and it would apply to property that's acquired or placed in service after January 19th of 2025. So back to the beginning of the year on Inauguration Day. Going forward, you're going to be able to get 100% bonus depreciation with it there. So, Emma, that's something that some states we've got to watch on as well.
Yeah, a lot of states decouple from this. So just because the federal is allowing the 100%, there may be some state adjustments we have to look at, and every state's kind of different if they follow this or not. So just be aware that just because it is 100% for federal, that may not flow through to the states.
Good. Okay. Thank you. Next one is the big one that's applied to a lot of our companies and businesses is this research expenditures starting in 2022. What you need to do with those R&D is you had to capitalize those instead of expense them currently. You had to capitalize and amortize them over 5 years if it was domestic research and 15 years if it was foreign. What the OBB legislation here would do is go back, start at the beginning of the year, starting here for 2025 for calendar years, and go through 2029, is you'd be able to go back to current expensing. The proposal actually gives you really 3 options. You can deduct it currently, you can still elect to capitalize and amortize it over the 60 months, or you can actually elect to amortize it over 10 months if you wanted with it. So that's what's proposed in here. And again, that would start for the 2025 year. Next. Foreign research, however, if you do have any businesses with that, would still remain to capitalize that, have a 15-year amortization with it. If you do have any disposals with it, any unamortized costs related to any capitalized reserve would be able to be expensed or written off at that point. Under the current law, you actually have to continue to amortize that through the whole recovery period. So that'd be a favorable change here. And the last thing is with the research credit, what you would have to do now, once we get the current expensing, is any R&D credit that you have, you'd have to reduce your R&D expenses by the amount of that credit, or you could take a reduced credit. That was the rule before TCJA was enacted, that's going to come back in. So you're going to have to look at how the interplay between the R&D expense and the credit works. And again, that will start here again for 2025. Next. A couple things with this. Again, it's going to start here for the 2025, go through 29. Transition relief here. One thing just to note, a lot of folks have asked about this, is any of the amounts that you capitalized back in 22, 23, and 24, you're going to have to continue to amortize those through the 60-month or through the 5-year period. New expenditures that you incur for 2025, you can expense, but you're still going to have those prior 3 years that you're going to have to do and run those out for the 5 years. So keep that in mind. And if you do have any short tax years involved, they're going to issue some guidance on that. So we'll keep an eye on that if anybody has any short tax years for 2025.
And then,
Emma, what does the state do with this year?
it depends on the state. Every state kind of follows their own thing. Wisconsin's one that's decoupled from 174. So just in that year, while we're taking those expenses, we could see an add back for what some of the states that were allowing the 174. So we just need to make sure that you're talking to your tax professional about those adjustments and making sure that they're being properly reported on the state if this changes.
Good, thank you. Next one relates to one of the other business ones, is this 163J. And again, it's the impact or the adjustment to interest expense deduction that's limited. Again, this started, before that, you used to be able to, you had this limitation that it was just they call it an EBITDA limitation, that you'd have to go through, calculate the income before, interest, taxes, depreciation, and it'd come up with this, what they call adjusted taxable income. The higher that number was, the higher the limit was for you to be able to deduct your interest. Starting in 2022, however, they took out depreciation and amortization for that, reduced that adjusted taxable income, which reduced the threshold for how much you could deduct. So it was a calculation change, but it had the impact of significantly reducing how much interest you could deduct. Next slide. What the change would be, though, is go back to the rule before. So it would go back to that EBITDA limit, so that it would apply to a higher adjusted taxable income. So you could add back your depreciation and amortization, and it would make it easier for impacted taxpayers to deduct their interest. Again, that's going to start here for the 2025 year. In addition, floor plan financing would, there's an adjustment to that calculation for floor plan financing. They would add to that any campers or trailers that are attached to vehicles that are towed. Those will be added to this exception here, which again will expand that a little bit for certain businesses. So anyway, this is a favorable change here for those that have been subject to the interest limit, to have a higher threshold for them to be able to deduct their interest here starting in 2025. And Emma, what are some of the states have a little different treatment with that?
Yeah, some of the states have decoupled, so they allow the interest expense. So again, it's more making sure that we're tracking each state's add backs and subtractions correctly as these expire or change. Again, Wisconsin's one that's kind of decoupled. There's a couple other states that have that. We just have to make sure we're monitoring those add backs or subtractions.
Okay, thank you very much. Yeah, it's good to keep track of these, see what the changes are. Next one is 179. Again, another similar to the depreciation with it, but it's been around for a while, and that threshold has increased, that you can get certain qualified property. You can take the section 179 expensing deduction. That's indexed for inflation right now for the 2025 year. It's at $1,250,000, and when your additions exceed 3.1 million, that expensing limit gets phased down. What the proposed change would be is to even enhance that more, would double that to $2.5 million annual expensing, with a phase out starting at $4 million. So again, a significant change with that. And again, that would start for the 2025 year, and that would be a permanent change. So there's no sunset with that. So Emma, what would that have as far as any states with that on the 179?
Again, just kind of like federal or the bonus, some have followed this, some have decoupled. Most states kind of set a limit, and the phase out is a lot lower. So less states follow the 179 with that. So again, just another area that we have to make sure we're properly accounting for.
Yeah, so you could have some federal state differences again with this 179. So
And they
okay,
can be very significant between
correct.
all three of the depreciation, 174 and 163J. You could have significant add backs in some years and subtractions. So that could truly shift your state income every year. And it's something, again, we want to monitor and look at when we're planning also for estimates and things like that from year to year.
Good. Thanks, Emma. Next slide. Next one is really a new provision. Again, sort of the administration's theme of trying to get the production manufacturing back into the U.S. here. And it's this new depreciation, sort of a separate one, different from the bonus depreciation. It's called qualified production property. And generally right now, when you have depreciation for real estate, real property, non-residential property gets a 39-year life, and residential rental gets 27 and a half years, again, on a straight line basis. Sometimes you do a cost segregation study to carve out equipment that gets a shorter life or maybe bonus, but then the real property, has a much longer life. What this new provision would be, this QPP, is it would allow 100% expensing of the whole facility, which would include what would be 39-year life. So it'd be a significant acceleration of your cost to build that new factory or facility. Next slide, please.
And I think that, Jim, that covers the rules there cover the manufacturing portion of a facility. So if you have a combined use facility, you would need to segregate those. Yeah.
Correct. Yeah. So here's some of the requirements for it. Again, we've listed a few of these here. Again, it has to be in the U.S. as a qualified production activity. These are rules that will have to be defined. Construction that started here and it's placed in service after the bill is signed into law here. And it's an elective provision. So again, in some cases, you may not want this. So they'll have to indicate how you're going to elect that. And again, generally, if you're going to be making tangible property, you're going to fall within this. But again, this would be where guidance will be important with it from the IRS, so people can look to say, okay, we're going to put this new facility in. We want to make sure it qualifies. Next slide, please. As Tom had mentioned here with this, again, there's parts of it, again, when you're going to get, part of the building or the facility, the administrative offices, lodging, certain parts of it will not be eligible for that. It's just going to be the production part of the facility. So again, you may still need to have a cost segregation to kind of split out what's the office area from the production area to see if you're going to take advantage of this. In the original use, it's either a brand new building or one that you didn't use it. We've got an effective date going back to January 1st, so something to watch. The other thing is if you put in service this new production facility, there's a 10-year period that you need to hold that. So if you take and get this large expense and dispose of it within 10 years, you may have some recapture of that. They do have some recapture rules on this to be aware of. It gets accelerate some of the the activity with it. Anyway, we'll have some guidance on that. There's not really particular rules in place on that now, but again, we'll have to watch what happens if you do dispose of that within that 10-year period. And again, this is available for the property that's placed in service after enactment. So whenever this bill is finalized, that's when this would be effective. So something to keep an eye on if you're looking at a new factory facility. Again, you're going to want to be up to speed on this to see are you eligible for it and how you can qualify for it. Next slide. This is an important one, again, sort of dovetails on that, tying with manufacturing, just to be aware of. And what they're looking to do, and again, this would be for manufacturers, is to expand some of there's some accounting methods that TCJA put in several years ago that applied to all businesses, the use of the cash method to avoid the unicap inventory, to calculate just tracking inventory, and also this this interest expense limitation that we talked about. If you're a small business, which was less than 25 million of gross receipts, which is now up to $30 million, you don't have to keep track of those items, or you can use different accounting methods. What they're providing with this one is to increase that manufacturing relief. That number is going to go up to $80 million. and that's indexed for inflation, but that index actually goes back to 2018. So that current threshold would be roughly $100 million, and that starts in 2026 here. So if you're a manufacturer, you're going to be able to look at this, and that's a pretty good sized manufacturer. You know, you could be 50 or $80 million manufacturer, and you could not have to worry about being subject to the interest expense limits. You wouldn't have to worry about unicap. So that would be an attractive item to watch if this goes through here. That would start in 2026. So something that manufacturers should definitely keep an eye on as this bill moves forward. Last time we're going to just talk about is this an employee benefit, again, that hasn't seen too much activity. They're looking to expand it here. It's a Section 45F. It's an employer-provided child credit that companies can get up to 25% credit for child care expenditures. The maximum credit is $150,000. Again, if they have their own facility or they contract out to have, in some cases, be able to have child care facility for their employees. Next slide. What would change with that is they're going to increase that to 40% with it, and for small businesses it goes up to 50%, and the amount of the credit is $500,000 and $600,000 for small businesses, and then indexed for inflation. So significant opportunity there with it, and they're enhancing the definition of what qualifies for child care with it. So you could have some outside party to perhaps help line up the child care with it or partner up with other businesses. Those are some options. That will start here in 2026. So again, in some businesses that are mid-sized, trying to maybe provide for their employees when, you know, it's a tight labor market, this may be one that they may want to explore on that, or if they're already taking advantage of it, it'll be enhanced quite a bit. So something we thought we'd just point out to you here in the bill.
Okay, let's go to the next poll question. Jim, do you want to?
Polling question here. Which of the following business provisions are most beneficial, or do you think would be most beneficial to your business that you've got? Reinstatement of the write-off for R&D expenses, reinstatement of 100% bonus depreciation we talked about, this employer-provided child care credit, or the reduced interest expense limitation. So if you could indicate your preference or your polling choice here with that. Got about 75% voted here already. Okay, we'll turn that off in a moment here. Okay, it looks like the bonus depreciation 60% is the top one here. The R&D is 20% is next, and then the interest and the child credit round out the choices. So thanks for that. Perhaps not unusual that again the bonus depreciation again applies across industries, and small and large companies can take advantage of that. And again, that's an attractive benefit, and not surprising that ended up our top vote getter, if you will. So thank you. Okay. Tom, I'm going to move over to you here to look at some of these other individual
provisions. You know, there's just some themes here, Jim, you mentioned, which obviously we've heard over and over, but onshoring, you know, bringing back manufacturing to the U.S. You talk about the federal SGO proposal, providing incentives to, you know, fund education. You know, one of the other themes here is how do we help folks in retirement, you know, and how do we help folks save for, you know, medical expenses? And so there's really an expansion of the HSA, which is a terrific tool. If you don't know about the HSA, this legislation actually expands it and gives you more utility, more applicability to Americans. So talk a little bit just about the proposal. So HSAs right now allow us to put some money away for qualified medical expenses on a pre-tax basis, and then the money can come out on a tax-free basis, right? So some call the HSA the triple threat. The proposed legislation, one of the things that you can't do currently is when you are Medicare eligible, you can't contribute to an HSA anymore. proposed legislation allows those that are just in Medicare Part A to continue to contribute. So even after you get on Medicare Part A, you can contribute and put more money away for medical expenses that might come up unexpectedly. Also now this proposal would enhance to cover primary care services, sort of direct pay type services. Those are qualified. And then lastly, for those that are getting a either bronze or catastrophic plan from the marketplace, those now qualify as a high deductible plan. As we know, to do an HSA, you have to be in a high deductible plan. So next slide on this. Also expands some other qualified expenses to include, physical fitness facility type membership fees to a limit. So really trying to encourage Americans, give them an incentive to join a qualifying fitness facility, do more exercise. So that's now a qualified expense. A little cleanup on your spouse on a catch up, being able to contribute to the same HSA, rollovers from different FSA and HRA accounts, and then the last one is to allow people to that incur expenses before the HSA is in place to go ahead and call those qualified. So a lot of good little enhancements to HSAs there. The next one is a new one. We've been reading a little bit about this over the last couple of years. And so, as Jill mentioned, the parking tax earlier, just remember that ideas float around in Washington for years and years, and it's sort of like they take them off the shelf and throw them into a piece of legislation. And I think this is one that's been kicked around for a little bit. In Europe and Canada, they have what's called universal savings accounts, and effectively, we're delving into that concept here for the first time. So we call it a Trump. The proposal calls it a Trump account, and it's for the exclusive benefit of an individual, and the beneficiary, as we see, must be when less than age 8 at the time the account is established. So we set the account up at a young age, and we contribute to it, and contributions limited to $5,000. We could have some rollovers, and rollovers, we've got to see the rules on this, would not be subject to that limitation. And then there's also some other rules yet to be put together on this in terms of contributions from tax exempts. So let's go to the next slide then. So we'll look at that Trump account and see if that makes it in the final bill. One of the pay-fors here is to, we'll go to the next slide, please, to curtail, if you will, or stop these energy credits, energy incentives a little earlier. I'm sorry, go one more slide ahead, please. We'll get to the energy credits. We're getting close on time here, so we're going to jump over this slide. There you go. Thank you. Some of the energy credits for enhancements to our home, to our business, those are proposed to go away early. Now, this is a hotly debated topic in the Senate right now, so we'll see where that ends up. But be aware that maybe at the end of the year, some of those things we might think of, new windows and things that are eligible for an individual tax credit, may go away after this year. So we'll just have to watch that. Lastly, another topic here, which we have the next slide, please. There was a proposal related to employee retention credit. As of this morning, it appears there's a proposal to take that out. So this is just another example of this thing moving along pretty quickly. So anyway, let's go to the next slide, and Jim, you want to talk about next steps real quick as we hit
Yeah, we're just getting to
top of the
getting to
hour?
the end here. Thanks, Tom, very much. And again, this bill is kind of moving here with it. The last thing is, again, as many of you know, again, the bill passed the House and now it's in the Senate with it. The Senate realizes that there's a thin margin in the House, but again, it wants to put its input on the bill. And a couple of outlook on the taxes in the Senate side. Again, the Senate generally supports the bill. A couple of things they'd like to do is make some of the provisions that we talked about, the bonus depreciation, the research expense, and the interest limit permanent instead of only apply through 2029. The SALT deduction is still up in the air, very costly with the budget score with this. But again, they realize that if they do anything with that, it could jeopardize it when this bill goes back to the House. So there could be some other things. Again, the Senate Finance is scheduled to release their projected tax changes. I think Friday is the last I heard for that. It could slip over till over the weekend, but that's when they're going to come up with theirs. But don't expect too many changes, but there will be some, and these are just some indicated changes. Next slide. A couple of things to watch for. Again, I think there's more differences on the spending side in the Senate, and again, we'll see where that comes out, that they're looking to cut more spending than the House did with it. Again, the tax, they're more in line with what they've got. But again, do they have enough time to make all these changes? We'll have to see. Again, I indicated some of the senators to watch here with it, who could be ones on the fence or may not support the bill. Indicated some of those, so things to watch. Next slide here. Just some things that are coming up with it. This, not to get into detail with it, but this is where the bill has to look at to make sure that it fits within the budget reconciliation rules. That'll happen perhaps next week with the bill if they get that far with it. Then they have an amendment process with it before it gets a final vote. So again, if the vote ends up at 50-50, the vice president will cast the tie-breaking vote with it. So that's kind of the outlook with it. And again, here's the timeline with it as we finish up here. Again, administration and Congress would like to have it by the July 4th holiday with it. I think that's a little ambitious goal with what they still have to do, especially in the Senate, and then bring it back to the House. Again, it might be optimistic. If not, I think they have a backstop of getting it before the August recess, so they come back after 4th of July. That might be a little more realistic. Again, the more changes that the Senate makes to it, I think it makes it a little bit more a task to get it done by that date. But we'll keep an eye on it. Again, we should learn a lot once the Senate unveils their bill here in the next week. So that's where we're at now at this point. Again, we appreciate it very much. And Tom, just some closing housekeeping items for us.
Well, thanks everybody. Thanks Jill and Emma and Jim for the great content. As a reminder, we have a survey. If we'd like for you to complete that to receive for those that want CBE credit. The certificates will be sent out in the next week or two. And if you have asked a question that wasn't answered, it's because we can't. I'm kidding. We'll get you an answer. We'll follow up with you individually. And as we mentioned in the beginning, was recorded. The webinar was recorded. We did cut out the part at the beginning where we had the little glitch, so we're good there. So, kidding. You will get that. And then, lastly, thanks a lot for attending today. Let us know what else we can talk about that will add value to you or your business. And go Pacers.
Good luck to your Pacers, Tom. Thank you,
Thank
everyone.
you.